And here you have it. Tesla is approaching oversold territory for the 4th time in the past 12 months. Each of the previous instances saw the share price immediately bounce higher by a minimum of 30%. Does Cathie Wood know something about Tesla that we do not? See, I am a firm believer of if you are connected on Wall Street, if you are a Cathie Wood, you are going to know inside information that the average folk does not. I've seen it time and time and again in my almost 10 years of investing. Specific firms start to buy a lot of stock in a random company and a buyout happens. A lot of unusual options hit a company and a buyout happens, or some positive catalyst occurs. It's no secret that in 2024, Tesla's stock has been falling like a rock. Elon Musk just cut prices in China by 6%, and that has certainly not helped anything. At the same time, Cathie Wood is aggressively buying the dip in Tesla stock. Strength Plan on X says Cathie Wood knows something. Cathie Wood on Friday, on January 12th, bought 18,000 shares of Tesla in her ARK-W fund and bought 93,000 shares of Tesla in her ARK-K fund. This was another 112,000 shares that was bought by Cathie Woods. Now, I don't know exactly if Cathie Wood has insider information or knows something is going to happen for Tesla. It just stands out to me that Tesla stock has been falling so aggressively. Cathie Wood has started to buy Tesla stock, even with the prospect of Elon butchering the 3rd earnings call in a row coming on January 24th and seeing even more downside in Tesla stock. This also comes at a time where a lot of Wall Street is just not bullish on Tesla at all. Maybe Cathie is just doing what a diligent fund manager would do and buying the dip in stocks that she loves for the long term. Or maybe, in fact, she does know something that we are not privy to know as of right now. Let me know down below in the comment section what you think. Ladies and gentlemen, throughout the remainder of this video, we will go over my expectations for Tesla stock over the next coming couple of weeks, next couple of months. I'm obviously not a financial advisor. My predictions are subject to be wrong. At least I hope I'm wrong this time, because things don't look that great out there. The data is not looking great. Where we are in the markets, not looking great. And what we've seen with Tesla recently is not looking great. So I do hope I am wrong. If I'm not, then, well, you had a heads up here in this video. If I am wrong, well, that's great, because Tesla stock is probably much higher than what we're going to talk about in this video. But do not be confused, because I still think Tesla stock will reach around $450 by the end of 2024. The reason for that is pretty simple. If you just want it all in a nutshell. During pre-election years, it's common to see the first half of the year bad or not so great, the second half of the year being good. Now, the way that we are lining up right now, with rate cuts starting in March, $6.2 trillion currently in money market funds, the Fed is going to have to pivot and start accommodating the markets via their balance sheet runoff. Instead of doing $90 billion a month, they're going to have to drop that down to 10 or even maybe $20 billion a month. That's going to be a big stimulus boost, if you will, to our markets. Also, by the second half of the year, we should have a better understanding of whether or not we're heading into a recession. The second half of the year for Tesla as well is when we're potentially expecting a licensing deal for FSD technology and the announcement of a $25,000 vehicle. As Gary Black says, it could be coming soon, sooner than a lot of Wall Street investors expect, and well, you and I expect as well. These are all reasons why I think Tesla stock will hit new all-time highs by the second half of 2024. Even just consider the fact inflation has fallen from 9% to where it is now, just at about 3%. Long-term forward earnings are worth more. For an example, if you're a company like a Tesla promising to deliver 20 million vehicles by 2030, and you're promising to bring in, just call it $1 trillion of revenue a year, if inflation's 5%, well, compared to 2%, that makes a big difference on bottom line earnings, on valuations for companies today. Inflation continuing to fall makes Tesla more valuable. It specifically makes Tesla's earnings down the line in the future more valuable. But you will also be entering into a lower interest rate environment. As the markets are expecting 6 rate cuts in 2024, that should bring more money into higher growth names like a Tesla. But if you really want it to be super duper simple on all of this, there's a math equation that you can do. And it's probably like 5th grade, 6th grade math. Tesla, I think, will do around $4.50 of EPS for 2024. I think based on these other factors that I just mentioned, Tesla's multiple will expand from around 60 today to around 100 by the end of 2024. Could it be less than that? Obviously. Could it be more than that? Of course. I think it really depends on what is announced. A licensing deal for FSD? I would be utterly and completely shocked if Tesla stock did not hit new all-time highs on that. Completely shocked. But if Tesla announces the $25,000 vehicle in 2024, Tesla stock could go higher. So I actually think $450 by the end of this year, pretty conservative. Of course, could I be wrong? Yes. Will I be wrong in the near term? Yes. I'm not expecting Tesla's going to do well actually over the next couple of months. And really why that is because the markets right now have no idea about anything. The markets don't know if we're going into a recession, if we're going to avoid a recession, how many rate cuts we're truly going to get from the Fed, and how earnings are going to hold up. As you can see from this chart, we are going to get a lot more banks that will report earnings. Credit card companies like Discover Wednesday and after hours of this upcoming week. TSMC Thursday pre-market, that one will be very important. And then some more banks, really all banks, JB Hunt as well, Thursday after hours. And these earnings will be important, but we really need big tech earnings to come before we really know much. Markets right now are expecting 11% EPS growth for the S&P 500 in 2024. That is high in any normal year. If the consumer is really slowing down and there's fears out there and layoffs are happening, we even heard that on Friday with Google laying off almost 2,000 employees in their hardware division, making Apple Watches and phones. Well, that's not going to be great for earnings, at least I would imagine. Bottom line is 11% is high. And if stocks are trading on that, well, we may be surprised when earnings come in at 5% growth or maybe even negative. That would set the markets up for a lot of downside considering you're trading at, you guessed it, all-time highs. Hitting a new all-time high for the SPY on Friday doesn't exactly put you in a good position to weather bad news. That's one reason why I do think stocks will fall in the midterm, or really short term. I guess midterm's more like 3 to 6 months. That also makes sense as well. But in the very near term, coming in February, you could see stocks pull back quite a bit based on earnings alone. But then you have this situation going on under the surface in our markets. Money is going into big tech again, like 2023. It seems like markets are getting fearful over a recession. What happened last week was Thursday's CPI report came in hotter than expected. Friday's PPI came in lower than expected, but CPI is more important than PPI. I think that's pretty well known, right? Consumer prices more important than producer prices. Producer prices falling, that's great, but CPI came in hotter than expected. What happened? The markets priced in more rate cuts. For whatever reason, the bond market is telling you we're going into a slow period. We're going into a recessionary-like period where the Fed will need to cut 6, potentially 7 times in 2024. If that happens, either inflation has fallen like a rock, potentially is going negative on month-over-month basis, or the economy is really weak and the Fed needs to manage the business cycle at that point. Either one of those things could theoretically happen, but if we see that much of a rapid deceleration in inflation, it's going to come from services, it's going to come from housing. If services or housing start to roll over, well, most of the economy is actually already in a recession. Manufacturing, semi-chips, if you're not AI related, you're still not doing well. Different sectors just have not been doing well for 2 years now. These, I think, are problems here in the near term. Specifically, what you've seen on Friday that is very weird, very strange, and alarming potentially is the 2-year Treasury dropped about 11.5 basis points on little good news, on lower than expected PPI. But should that have caused an 11.5 basis point drop? Absolutely not. So what this is actually doing is causing your 10 and 2-year yields, yield curve to uninvert. Back on just the 5th, on Friday, January 5th, you were inverted 35 basis points. Now you're inverted 18 basis points. So you're starting to rapidly uninvert. Now, when you actually uninvert, typically you have about 5 months until you go into recession. So when you actually uninvert, you're normally already in a recession. Okay. What happened last time we started to steepen like this was from July-ish, you were inverted about 1%. Then you uninverted to about 15 basis points. I think 13 basis points inverted was the closest we got to uninverting. That was in October. What happened? Stocks came down big time, about 10.5%, almost 11% from late July through the beginning or late of October. We haven't seen that happen yet, which I find fascinating. One of those reasons could be the 10 and the 3-month yield curve. So same thing here, right? Last time in October, you were inverted 64 basis points. You were rapidly uninverting as well on the short-term bonds. Well, now you're not. Now you're really not uninverting here, which tells me something. It tells me that the markets are not expecting imminent rate cuts in the next 3 months, or not a lot of rate cuts. We're not expecting double rate cuts or 75 basis points of rate cuts anytime, in the next 3 months or so, maybe 6 months or so. But what this is saying is in the next year or so, with the 2-year treasury, at least, that's what this is saying. In the next year or so, we're expecting a lot of rate cuts, which is very strange. Now, one of the problems I see here is the Fed is dead set, what seems like pushing us into a recession, putting so much restrictive pressure on the economy until they start to see the economy actually looking bad. By the time that happens, it's typically already too late. The next Fed meeting is January 31st. So on top of Apple earnings, Microsoft, Google earnings, all of these earnings that we're going to get this week as well, you're also going to have the Fed to contend with. So that week is going to be off the chain volatile. Okay. The problem here is the Fed said they're going to cut rates 3 times in 2024. Most Fed officials you've heard, basically all Fed officials you've heard, have been either 3 rate cuts or less than that. They're not vouching for maybe more than 3 rate cuts. They're just not, unless inflation comes down more. And that did not happen on Thursday. So if markets are still pricing in 6 or 7 rate cuts by January 31st, Fed Jerome Powell is going to hawk down on our markets. He is going to say, no way are we expecting to cut rates more than 3 times. The markets might say, yeah, okay, 4 or 5 times. But you're still going to have a problem coming with Fed Jerome Powell on January 31st if we continue to price in 6 rate cuts. That's also a very near-term risk for stocks. Now, this all comes at a very bad time for Tesla because Tesla's already not been doing too well. Okay, Tesla's already been falling. So if you get more of these pressures, some of these other things we're talking about here in this video start to materialize, yeah, that's a big problem. Tesla stock could easily start to make its way to $200 per share and potentially even lower than that. And to make matters even worse, Jim Kramer is apparently advertising on Facebook that Tesla stock might be your next big winner. And as Hallmark's catalog rightfully says, we are so effed. Typically, when Jim Kramer says a stock's going to do well, it does poorly. And when he says a stock's going to do poorly, it does well. But more so on a serious note, let's talk about a couple of these charts over here on X. So this is a chart of the average return in the markets 195 days after the Fed cuts rates the first time. So what you normally see is stocks fall. Well, normally the Fed is cutting rates because not inflation is falling, but because something broke and they're trying to manage the business cycle and trying to avoid an even harder recession than maybe, what otherwise would have been. Sometimes they do a good job. Sometimes they don't. Most of the time they don't. As you can see, 07, you were down like 55% and it took 360 days to bottom. 01, you were down 40% and it took over a year to bottom, around 450 days or so. But what this chart really fails to address is if you get rate cuts solely based on inflation coming down with record low unemployment, I don't think that will be a negative thing. But the question is, does the data start to change? Does the data start to get worse? If that happens, then rate cuts from the Fed probably would not be seen as good news. But on average, it takes 195 days to bottom, and you end up falling about 23.5% on average after the first rate cut. So historical precedents are definitely not on the market side here. This can actually be seen as a little bit of good news. The short bear says the positioning in the US dollar is extremely short. Now, if the dollar falls, stocks will do well, okay? That's at least what we tend to see. When the dollar falls, stocks do well. When the dollar rises, stocks do poorly. The dollar and stocks like inverse each other, right? Because if you're a multinational taking in a bunch of different foreign currencies, when you convert that back to dollars, you get less dollars. So when the dollar actually falls, stocks do well. So the periods in which stocks have done the best, like 2021, well, the dollar fell a lot. The dollar fell from the high of the Rona, which was pretty artificial, so we'll go down to here, to the low, fell almost 12%. So stocks outperformed. What happened during 2022 when the Fed was raising rates aggressively? Well, from the start of 2022, the dollar rose about 20%. Stocks did very poorly. 2023, the dollar hasn't done much of anything. It's fallen a lot from the highs of 2022. What you've seen during the 11% sell-off in the S&P was a rally in the dollar. What you have seen since then, and the markets have rallied, was a sell-off in the dollar. Now, 2024 has started off pretty weak. What's happened? The dollar has been bouncing. If shorts are correct on the dollar and the dollar does indeed continue to fall, that could actually be a very positive thing for our markets, and I expect it would be. And here you have it. Tesla is approaching oversold territory for the fourth time in the past 12 months. Each of the previous instances saw the share price immediately bounce higher by a minimum of 30%. Whatever the reason is, Tesla tends to bounce when the RSI gets oversold, and I would expect nothing different this time around. But this chart is actually pretty shocking. Interest payments have now surpassed $550 billion a year. Take a look at this just ridiculous rise, right? Now, overall, people tend to be in okay shapes. Debts have obviously risen, but the amount of money people are making has obviously risen as well. This just doesn't look good. It's definitely a scary looking chart. You have to dig into it a little bit more, but definitely is not looking so great. Also, a little bit of good news. In about the next 3 months or so, 2 months or so, the reverse repo market is going to run out of capital. You're at $603 billion right now, and the Fed will have to reduce the pace of their balance sheet runoff. Again, I mentioned this previously, but here's the actual chart and the projected trajectory of the Fed, of the reverse repo market. When this runs out, you're back to quantitative easing, or at least not quantitative tightening anymore, and that will be a positive for stocks. Credit card spending has apparently collapsed. As you can see here, credit card spending is below pre-pandemic levels. Not exactly sure how that's possible, but it looks like the last 5 months or so, 6 months or so, people have really stopped spending money on their credit card. And the probability of a recession in 2024 is elevated. This is based on the yield curve 12 months prior. So you can see you're at about 70% right now. The last 2 times this happened, in the 70s and in the 80s, you went through some pretty aggressive recessions to follow. So we'll see what happens. Eventually there will be a recession. Question is does that happen in 2024? Does the economy take a downward shift? Let me know what you think down below in the comment section. As for Tesla stock, I would imagine things get worse before they get better from here. Now, I'm not expecting things to fall in a straight line though. Tesla is oversold on the RSI. You're due for a bounce. Tesla stock likely to bounce. And the bounce could be aggressive, could be a 30% bounce. Who knows? But I do expect recession fears will likely enter this market at some point in the first half of this year, whether it's in February or March or maybe April. Maybe on my birthday, April 1st, you'll get some recession fears. Happy birthday to me if you really think I inverse with everything I say. Maybe April 1st is when things get much better or much worse. Have to wait and see. But I am expecting a bounce in the very near term, but then I am expecting more downside from here. Now, would it surprise me if Tesla continued to fall? Absolutely not. We did get the Indian factory that is basically confirmed over this weekend. We do need final confirmation before the algorithms likely react to that. And then we're going to get Tesla earnings on January 24th. But yeah, I'm not sure those catalysts are, at least Tesla earnings, are going to help that much. The earnings call is probably going to sound pretty rough. Elon's probably going to sound pretty doom and gloomy. And we've seen it in the past that has not helped Tesla stock go higher at all. So let me know what you think down below in the comment section. I still stand firm with the second half of the year is going to be much better, much better than the first half of the year. And I think I'm pretty confident in that. But I would love your takes down below in the comment section. Hit the like button as well as subscribe to the channel. Thank you for watching. If you guys want to come trade with us live in real time, no matter what happens, if the markets go up, down, trading sideways, spin in circles, doesn't matter. You could still be set up in a way to profit in our markets. Check that out. Link down below in the description of this video. I believe we have over 200 members now, so it's a great place to be. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.